We begin the day deep in the red. Stock markets here in Europe suffered their biggest losses of the year on Monday as the shockwaves from a major bank collapse in the U.S. spread around the globe. On Friday, the Silicon Valley Bank, a regional obscure bank, tanked after it spooked customers with plans to sell its own shares to cover losses. In the span of 48 hours, the fear of contagion forced U.S. banking regulators to shut down another bank, the New York-based Signature Bank, on Sunday. The speed of social media plus the cryptic impact of cryptocurrencies, both factors in this government intervention. On Monday, trading in some banking shares was temporarily halted on Wall Street, and it came after U.S. President Biden attempted to reassure the public that this is not another financial crisis in the making. If not, then what is it? We begin tonight with this report.
The news sent bank stocks tumbling in the US, Asia and Europe, with investors fearing the biggest US bank failures in 15 years might trigger a ripple effect around the world. EU authorities say they are monitoring the situation, but do not expect the US failures to cause long-term problems in Europe.
We take note of the swift and decisive reaction by the US authorities. Within the EU, there is a very limited presence of Silicon Valley Bank, and of course we are in touch with the relevant national competent authorities.
That message was echoed by EU finance ministers, including Germany's Christian Lindner.
We have our own authorities in Europe. In Germany, for example, we have our own financial regulatory body which is continuously monitoring the situation. These institutions have no doubts whatsoever about stability.
This changes nothing for Germany.
Nothing. I have faith in Germany. Bye-bye.
In the US, the failures have brought back painful memories of the devastating meltdown of 2008. In a bid to lessen uncertainty and avert further bank runs, US President Joe Biden hurried to reassure the public.
All customers who had deposits in these banks can rest assured. I want to rest assured they'll be protected and they'll have access to their money as of today. No losses will be borne by the taxpayers. Instead, the money will come from the fees that banks pay into the Deposit Insurance Fund.
Biden stressed that, unlike in the past, irresponsible behavior by banking executives would not be tolerated.
The management of these banks will be fired. If the bank is taken over by FDIC, the people running the bank should not work there anymore. I'm going to ask Congress and the banking regulators to strengthen the rules for banks to make it less likely this kind of bank failure would happen again.
Those rules were introduced after US banks sparked a global financial crisis in 2008 by aggressive mortgage lending. They were partially repealed in 2018 under then-President Donald Trump. In the coming days, that decision is likely to be in the spotlight.
Joining me here at the big table now is my business colleague, Stephen Beardsley. Stephen, people are asking, how does a relatively obscure regional bank, SVB, suddenly become the second largest bank collapse in U.S. history?
Yeah, it begs the question of what system risk really is, right? This was a debate that we had 15 years ago over and over and over. It was a debate that we had again in 2018. And now, like you said, regional, small to some extent compared to some of the other big banks. But it's worth saying that this wasn't really that small. I think it was 15th or 16th in terms of total overall assets when you look at all of the banks in the U.S. And the region was actually very important here. This was a tech-heavy region, as we both know at this point, as many of our viewers have heard. And that meant that it went boom or bust with this specific branch. And as we may have noticed over the past few months, it's been the tech branch that's been hit more and more by the economic downturn, many layoffs. And what the bank said was that its cash burn rate had increased so much. In other words, its deposits had fallen so much that it immediately threw it out of whack, and the rest of it went from there.
But the people in charge of the bank, they should have seen that coming, right? With inflation and with rising interest rates. I mean, this stuff didn't happen overnight.
Yeah, this is one of the biggest criticisms, right, is that this wasn't a surprise that came out of left field. This wasn't even based on a questionable security like a mortgage-backed security that dominated really the last financial crisis. Was this very questionable sort of collateral sort of gimmicky sort of product that the banks were sharing with each other. This is really based on long maturity treasury bills. And so they should have been able to see the writing on the wall, seeing that interest rates were rising and saying, hey, our values are falling in assets and we're heavily dependent on a branch that's going to be hit especially hard. When we need cash, when we need liquidity, do we have it?
Weren't the banking reforms that resulted from the financial crisis 15 years ago, were they supposed to prevent what we're seeing right now?
They were, but again, it goes back to this question of what size of bank is really systematic risk? And that was something that became a political football. Now, the piece mentioned Donald Trump and the reforms of 2018, in which basically those reforms that initially came out under the Obama administration deciding or defining the size of a bank that was a risk to the system, it changed that definition, and it changed it and raised the requirements much higher. It said that anything below $250 billion in assets was not a systemic risk, essentially, and would have less scrutiny than those above that. Less regulation, fewer stress tests, less liquidity requirements. There couldn't be a sudden liquidity demands or capital proof that was required of them, like for banks that had more assets, for example. So yes, there will be a lot of questions about this. Was this the right decision to make in 2018? At the time, those who were in favor of this said, look, these institutions, small, medium-sized banks, they need more flexibility to lend, to get money out there into the economy. It's going to go back into a political discussion.
It seems now that regional banks all of a sudden are now suspect in the United States. I mean, we've heard from people today asking people in the United States, will this wipe out my retirement, or if not my savings, if this continues to grow?
Yeah, I mean, I think it's early to say that. This isn't the same kind of system-wide kind of threat that we saw back in 2008, in which the larger banks in particular were being hit. There is, of course, deposit insurance that will protect most people's savings. But, of course, some larger pension institutions, investors are likely to be involved in this, as they were in the British liquidity crunch that we saw last year, and that could affect some people. But more than likely, this should stay around the regional banks. That's the hope. But again, there's such a psychological aspect to this. So that could cause trouble in the days ahead, and that's exactly what Biden and the administration are going to try and prevent. But to what extent are they going to promise to make depositors whole? It gets into this whole issue of moral hazard. Yeah. It's a really tricky situation.
Stephen Beardsley, as always, Stephen, thank you. U.S. President Joe Biden, today he stepped in to reassure Americans that the banking system there is safe. How do you feel about your money? DW News went out on the streets of Los Angeles to ask exactly that question to customers of the next bank that's under pressure, the First Republic Bank.
I'm really not that worried about it, but I'm just being a little cautious. I don't think people need to panic at this point.
The depositors, they could have waited. I don't think there was that much urgency to really take it out immediately. But, you know, they got to be safe and sound. So I understand what they did, but I personally think it could have been avoided.
It's just horrible. I don't understand how something like that happens. But then I also know when you put someone in office who's incompetent and he relaxes, rules and regulations that put banks in place, that kind of does happen. So I guess this was coming. So, yeah, I am blaming Trump for this.
Well, I wouldn't say worry, but I want to take some precaution. That's it.
What exactly are you doing? Are you taking money out, or?
I'm transferring some of my money out of this branch to another branch that I have. But at the end of the day, it's about panicking. If everybody panics, then it's like a domino effect. So I don't want to panic necessarily, but I just want to take some precautions.
Well, my next guest is well placed to judge how what happens in the U.S. can have knock-on effects right here in Europe. Nicolas Veron is a senior fellow at the think tank Bruegel in Brussels and at the Peterson Institute for International Economics in Washington, D.C. And he joins me from Washington tonight. It's good to have you with us. 15 years ago, we were promised no more bank bailouts because the banking sector and regulators in the U.S. and Europe had learned their lessons. Are there parallels that you see to 2008? I mean, SVB seems like a bank too small, too obscure to fail now. I mean, what's different this time?
Well, I'm not even sure where to start because there is a lot of blame to be apportioned, both in terms of the supervisory failures, the failure of the authorities to properly regulate and supervise Silicon Valley Bank so that this wouldn't happen. And then in terms of the crisis management, I think it hasn't been very convincing, at least on the basis of available information. Maybe there are better arguments that the authorities haven't disclosed yet. And I think at the end of the day, the big decision that was made to guarantee all deposits, no matter how large, beyond the insured deposit limit of $200, which in the U.S. is $250,000 per account, that decision was announced yesterday, and I think it's massive overkill, which will have detrimental consequences in the future in terms of moral hazard in the U.S. banking sector. Well, so I think there are lots of questions here.
Nicholas, talk to me about this moral hazard, because I mean, as I understand it, the only reason that they can guarantee all of the deposits at SVB is because we're only talking about 1 or 2 banks. But what would happen if we had 30 banks that were to go belly up? The FDIC does not have enough money to guarantee everyone's deposits, does it?
Well, in a way it does, and in a way it doesn't. So, I mean, the answer to your question is if we have 40 banks, they will do the same, because at this point they cannot afford to do anything else, or at least that's my reading. Now, how are they going to finance it? That's been communicated yesterday. There will be what is called in the U.S. jargon a special assessment on U.S. banks, which actually means a levy, asking the banks to pay, asking all the other banks, the ones that are better run, to pay for the failure of Silicon Valley Bank and Signature Bank. And to a certain extent, you can do that because the U.S. banking sector is big, but it's not what you would like to see.
And they're going to just pass on these extra fees to their customers, right?
Exactly. So when Joe Biden says there's no cost to the taxpayer, he may be technically right, but there are 2 caveats. One is that there is this special assessment, which means basically a cost being passed on to the U.S. economy, anybody who uses banking services, because the banks are not going to absorb all the costs by themselves. They can pass some of it on at least. And the other thing is that if things really go bad and the FDIC can no longer basically finance the guarantee of deposits through levying money from the banks, then the U.S. government will have to guarantee it, because, there's no way the U.S. government can let the FDIC fail, and everybody knows that. So at the end of the day, the taxpayers are providing the ultimate guarantee for this, and that's pretty scary.
And this is a chance where maybe President Biden and the U.S. government, they're missing an opportunity to show some tough love with the banking sector. Would you agree? I mean, I know that Silicon Valley Bank, they're connected to startups, but on Main Street, the plight of a Silicon Valley Bank is not going to matter much to people. They're going to be worried about their retirement accounts and their savings accounts, and yet it seems that this Silicon Valley Bank, they're getting a free ride here.
Well, specifically the customers of Silicon Valley Bank. So President Biden said, the shareholders and bondholders and management of Silicon Valley Bank, they're losing everything. And by and large, that's true. But then think of the shareholder and management of all these startups that had their account at Silicon Valley Bank, were doing completely incompetent treasury management, were not managing their financial risk properly. Some of them didn't even have a second bank account anywhere. That's not very competent. And these people, the shareholders, the managers, they are being bailed out. That's a bailout of Silicon Valley. Now, everybody loves Silicon Valley. Maybe it's good that we bail them out. Maybe it's not. You tell me.
Well, you tell me, what do you think about these startup executives? Should they have done their homework better and maybe put their money somewhere else other than with SVB? I mean, don't they carry some responsibility here for what they do with their money?
At any rate, I would say, venture capital and startup business, that's the business of making risks. And the very concept that these entities have a right to being bailed out by the U.S. government, because that's what happened yesterday, is something that I think should trigger a lot of debate.
Nicholas, let me ask you before we run out of time. European stocks, they suffered some big losses today. Should they be worried that this is just the beginning of something that will not end well on this side of the Atlantic as well?
I don't think so. I mean, of course, we'll see what comes with the next few days, and I've been surprised. I tell you the truth, on Friday, I didn't expect this big failure because, frankly, I thought the U.S. supervisory system and the Fed were doing their job to prevent that kind of thing from happening. So, at this point, I don't know what to think. But I think the structure of banking and supervision in Europe is very different. The technical term for what went wrong with Silicon Valley Bank is interest rate risk in the banking book, and that's been an area of focus for European banking supervisors for several years. So nobody knows, but at this point, I'm not expecting a lot of contagion to Europe beyond the normal and predictable moment of fright in the stock markets.
I think a lot of people are hoping that you will be proven right. Nicholas Véron, we appreciate your time and your insights tonight. Thank you.
Thanks for having me.